Hi guys, it's Kim here at OC Tax Break. Welcome back to my videos. Today we are going to be talking about the difference between cash accounting and accrual accounting and why this is important. Before we get into it, make sure you guys subscribe, hit that bell notification, and give this video a big thumbs up. I hope you guys enjoy this video, and let's get right into it. So what is cash accounting versus accrual accounting, and why is it important? So I'm going to tell you a little story really fast. I have a client who was audited, and they owed $150,000 after the auditor came and looked at everything, and that was their initial assessment, that they owed $150,000 for the year 2017. So when you're audited, the auditor will request your bank statements, your credit card statements, any receipts that you have. And when they do the initial assessment, they look at what income has come in on your bank statements and then what expenses have gone out. They don't really care what category it is at this stage. They just kind of look and see, okay, this is, you guys had $1 million in sales on your bank account, but on your Schedule C or your 1120 or whatever form it is, you guys are showing $2 million, or you're understating it, say you're showing only $700,000, which was the case in my client. Is they had $1 million on their bank statement, but on their Schedule C for 2017, they were only showing $700,000 in income. That's a huge significant amount. That's $300,000 right there. So why is cash versus accrual accounting significant in this case? Well, if you're doing cash accounting, that means based off your bank statements, whatever's coming in is what you're going to be claiming for the year. And on their Schedule C, they wrote that they were a cash client. So they used cash accounting, when in fact they weren't. They used accrual method instead. So they did it not based off their bank statements, but they were doing it based off invoices and when they were getting paid. So in, say, 2017, they invoiced $700,000 to their clients, even though they were getting paid on their bank accounts for stuff that was coming in from 2016. So say in January of 2017, they had $100,000 coming into their bank, but all of that income that came in was actually from invoices in the previous year, 2016. So this makes a significant amount of difference. So make sure when you guys are reporting on your Schedule Cs that you guys are doing it correctly. You're checking that cash if you are doing it based off bank statements, and doing accrual if it's based off of actual invoices that you're invoicing. Even though you're not getting paid right away, you're only doing it based off those invoices. What is cash method? A cash method is the simpler of the two. It is known for the ease and use of the cash flow. You are not going to have an accounts payable or accounts receivable with it. Income is claimed as it is received, and expenses are claimed as they are paid. So if you invoice somebody on January 1st and you're paid on, say, March 15th, your income is going to be tracked on March 15th. So that's when you're claiming your income. And say on December 31st of 2017, you write a check for $5,000, but it's not cashed until January of the next year. You're claiming that when you wrote the check on December 31st. So make sure that you guys keep track again of when you're paying them out on your check stubs or Venmo or however you're paying it. You're keeping track in your QuickBooks or your Excel of the correct date so that you can claim it in the correct year if you are using either one of those methods. Another advantage of this cash method is that you guys are only paying taxes at the end of the year when you file your tax return on income that is received, not on what you've billed out. So it's great for cash flow. The disadvantages of using the cash method is sometimes you get like that inaccurate financial picture. You're sometimes getting paid for something that was invoiced a couple months ago, so you'll have an inflated month or a deflated month when in actuality you billed out in those months. So keep that in mind too, that the financial picture isn't always the most accurate either. You're not having those accounts payable, accounts receivable. So because that method is so simple, it doesn't require you guys to use it, so you don't really have any records of what's outstanding or what you guys owe to people. The other disadvantage of the cash method is it doesn't conform with GAAP, which is generally accepted accounting principles. So if you are a company that makes over $25 million, you actually cannot use the cash method. You have to use that accrual method. So what is the accrual method? The accrual method is income and expenses that are recorded when they are billed and earned, regardless of when that money is actually received. So for instance, if you bill out something in January of 2017 and you don't get paid till March or April, you're still claiming that income when you bill it in January. So even if you're not paid, say you're not even paid for the whole entire year, you get paid in the next year for 2018, that income's still going to count in 2017 when it is actually invoiced to your client. Disadvantages of the accrual method is that it's a little bit more complex and a lot of people don't like using it for that reason. And then it shows a more inaccurate portrayal of the short-term financial situation for your companies. I hope you guys enjoyed this video. I hope you learned something. Make sure that you guys are claiming the correct method of accounting on your guys' tax returns. And if you have questions, comment down below, email me, which my email will be in the description below. I hope you guys enjoyed this. Give it a big thumbs up, subscribe, and hit that notification bell if you want more videos like this. And I'll see you guys in the next one. Thanks.